We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. How is the SP500 going to get to 4,000? Right, we're going to go through the subject. We know it's going to get there, but it's going to have to get there on somebody's debt. Now, Richard Vague wrote a book called The Next Economic Disaster, and his methodology to determine whether there was to be an economic disaster was to study private debt. That is the summation of household and corporate debt together, completely ignoring government debt. So it's the study of private debt. Right. So first of all, I want to make a highlight that the share market from 2009 upwards has pretty much been financed by the debt of corporations through buybacks. In the prior boom to 2009, it was buybacks and residential debt. And here, back here, was generally investment. I just want to highlight those charts as I go into the discussion. Right. Now here is the red line is the year over change, dollar change of total debt for households and corporations. And as the debt grows, so do the risk-on markets. And when the debt collapses, so does the risk-on markets. Okay, so debt is a high correlation to risk-on and risk-off. Now, as you can see here, very high peak here. That was the Nasdaq peak. Obviously, you can see that in there. This was the big peak of housing market and corporations, and this is pretty much all corporations. Let me explain that. Here is the same chart, but broken down. The red line is corporation debt, and the green line is household debt. As you can see, in the 2000 boom, it was the red line pretty much represents the Nasdaq debt. Okay, because that's where all the money went into technology stocks, and it ran out there, and the household debt was pretty tame. And when the technology stocks busted, the financial engineering exploded for the residential housing, mortgage-backed security and that sort of stuff, and the household debt took over, and corporation debt was pretty hurt for a while. So they replaced the damaged corporation debt with new household debt to get things going again. Okay, so then we had the collapse in the household debt, and pretty much everything went into the corporation debt to get things going again. Okay, obviously the Fed came in to backstop when there was a lag, and as you can see here, pretty much all the debt going into the markets in 2009 has been corporation debt. I refer you back to the share buybacks. That's where the debt has come from. And as we have had, as you can see here, it's the levels. This is dollar change. It's, as you can see, the levels got to astronomical levels once again. So we're just really waiting for the pebble to drop to break it. And we've had a crash in corporation debt. The household debt hasn't moved. Well, not yet. This is quarterly data, as at the end of the first quarter of 2020. If I get a bit of a close up in there, see that's the first quarter. So the question is, when the corporation buyback debt evaporated, there was no debt to do any buying of the stock market, and that's when the Fed stepped in with their balance sheet. Here's the little rally we've had, or quite a large rally, and this is the exploding balance sheet. Now the red line is the summation of the Fed balance sheet, swap lines, and the Treasury account. So this whole rally up has been sourced by your friendly Federal Reserve. Now the question is, obviously this is now tapered off a bit, so the stock market, as you can see here, is going sideways a bit. So the question is, how is the SP500 going to get the 4,000? Either it's going to be 100% of your Fed balance sheet, or we're going to have to get some debt from either the households or the corporations. So I'll scroll down one more. So my guess is going to take a while for corporation buybacks to come back into full swing. Obviously, revenues have plunged, balance sheets have been damaged, employees laid off. So you're going to have at least 2 or 3 quarters of the buybacks and corporation fueled buying of shares and supporting the stock market is going to be missing in action. So does that mean the Fed is going to be there to save the day? And the Federal Reserve has said they defended this point here because the Treasury market started not working when the US dollar got to 103, and no one was buying Treasury, so they stepped in to defend it. So my guess is, I think it's pretty obvious, the Fed's going to be the main player for the next 6 months. So this means the Fed will be at the support level of the SP500 or the markets. It's unlikely the Fed will fund the markets up to new highs because they don't be seen being the whole market. They're there in defence. And all this funding the Fed's doing is filling a hole. It's not adding funding on top of the mountain. So if you imagine a pothole in a road, they've all they've done is actually put money into the pothole to allow it to continue on. They haven't created a rise in the road where the markets can rise. So I suggest, my guess is we're going to get a bit of a test of the lows here, and then we're going to see if the Fed's there again to see whether they'll support the markets, because there's no money coming out of the stocks, out of the corporations. The obvious reasons: there's second wave talk, employment still doing damage, corporations' balance sheets been ruined, obviously the wider economic conditions. So it's going to be pretty obvious that we've had a new low. This low in the market here is lower than that low. At the moment, the high here is lower than that high. So we've had our first bearish mark on the market, and I think we'll probably get some sort of test of the low around here and see whether the Fed steps in again, which most likely they will, because there's no other debt fueling this market. So I believe we're going to be a 100% centrally planned stock market until the economy repairs itself. I can guarantee it's going to be centrally controlled until the US elections, and then after the US elections, will it be reliant on market forces or not? We'll have to wait and see, because I don't think the winner is going to be too involved in the next, in 2021 to prop up the market. This is going to be centrally controlled until the elections. So there's no debt coming from the corporations. It's only going to come from the Fed. They're not going to chase it to new highs. They're going to defend the lows. So therefore we can expect lows to be tested, in my view. Thanks for watching.